So what happens if everyone buys index funds? What if I told you that the most popular investment advice today could potentially break the entire stock market? Imagine a world where Warren Buffett's stock picking skills become worthless overnight. A world where companies' performance doesn't matter anymore. Where even the most innovative breakthroughs or catastrophic failures barely moves its stock price. Sounds far-fetched? Well, this isn't the plot of a new sci-fi movie. It's a scenario that some financial experts worry could become reality if we all follow the seemingly harmless advice to just buy index funds. And you've probably heard this advice countless times on the news, from financial gurus on YouTube or scrolling through your TikTok feed. It sounds smart, safe, and simple. But what if this smart strategy is actually too smart for our own good? What would happen if everyone invested in index funds? I get asked this question a lot, and unlike most proponents of index funds, I provide my straightforward answer. If every penny in the market were invested in index funds, we would have a broken market. But wait, let me explain why. So to illustrate this, let's use Microsoft as an example. Microsoft is currently the largest company in the S&P 500 and thus has the highest weight in the index. Now imagine this scenario. Microsoft CEO holds a press conference and announces that the company has given all its patents to Apple and reveals plans to abandon tech, and they want to enter the coal mining industry. In a world where everything is invested in index funds, Microsoft's share price wouldn't drop unless the outflows from the S&P 500 exceeded the inflows. This means Microsoft shares would rise or fall in line with the S&P 500, regardless of what CEOs are telling you. No active traders would be selling Microsoft shares, right? Because there would be no active traders. Even if Microsoft performed poorly, it would still remain the largest company in America by market cap. And of course, this could change since the S&P 500 is market cap weighted. But the general point remains. But then the next thing is important to know. Index funds and ETFs have surged in popularity. In 2024, total assets in US passive strategies surpassed those in active ones for the first time. This reflects a long-term trend. Passive funds have attracted more inflows than active funds for the past 9 years, according to Morningstar fund flow data. But active ETFs have managed to claim a meaningful slice of the market. While their active fund counterparts have logged outflows year after year, the active ETF market recorded a 37 average organic growth rate in the last decade. And this active ETF inflows show no signs of slowing down. And if you think of it, it works the same as fast food. Despite knowing the health risk associated with eating unhealthy food and dying early, still 42% of adults in the US have obesity. In contrast, you can see significant financial gains with hot stock pick, a successful mutual fund, or the newest cryptocurrency or meme coins. Headlines celebrate these victories much like casino jackpot wins. Just as everyone knows that casinos will generally win your money over the long run, people still gamble in hope of short-term gains. Similarly, active management will always persist, offering people the chance to outperform the market, even if the odds are stacked against them. Because let's be honest, from 1965 to 2022, stock picking by investors like Warren Buffett with Berkshire Hathaway achieved an impressive average annual return of almost 20% per year, transforming your $10,000 into an astonishing $387 million. And like eating fast food, chasing past and supposedly future winners can be addictive, right? Everyone likes to win. Plus, active trading also generates substantial profits for the biggest bank. They don't make money by outperforming a portfolio of index funds, right? They earn it by charging those who believe they can. And I have attended numerous conferences where CEOs from major banks make future predictions and attendees eagerly take notes, demonstrating their faith in active investing. There will always be believers, and it's relatively easy to keep them hooked, right? It's all about psychology. And if you don't believe me, check out the best trade videos on YouTube. You will find many people promoting active trading strategies. So, although American retail investors have more money invested in index funds, than in actively managed products, the majority of market assets are still held by institutional investors. According to Investment Company Institute, 84% of assets are actively managed. And what many people might not realize is that the proportion of active management is even higher in other countries. For example, in the Netherlands, passive investing accounts for about 30% of the market, while active management represents around 70% of the total market. So active investing still dominates, and passive investing among retail investors might peak soon. Many investors buy index funds without understanding how markets work, often influenced by friends and social media. I frequently receive emails from readers thanking me saying they made significant money since a certain year, proving indexing works. But many of those readers skipped straight to the what to buy videos on YouTube without understanding the rationale behind indexing. What they don't realize is that indexing works even during down years because the aggregate market return matches the return of all actively managed money in that market before fees. After fees, passive wins. In the same way, a liquid stock market with a healthy mix of buyers and sellers allows investors to trade easily, keeps prices fair, and this is why the continuous flow of buyers and sellers in index funds and the broader market is so important. It keeps the financial market running smoothly. However, investors who don't understand this could be easily swayed. Since 2001, we haven't experienced multi-year stock market declines. And when we do, active management advertisers will push hard on this. Active funds that kept large sums in cash during multiple year declines will claim they beat the market. And rattling index investors who don't understand how or why indexing works. Many will be tempted by the promises of active management and the talking heads on TV, but don't be one of them. And please don't eat unhealthy. So now you understand the implications of everyone investing in the market, you might be wondering how to avoid making costly mistakes. In this video, Jack Bogle, one of the most esteemed proponents of passive investing, who significantly impacted the average investor in a positive way and helped build Vanguard for the public, he explains why you should be aware of those 5 common mistakes that every investor makes.